Ladies and gentlemen, there is a number that almost nobody watches buried on page 40 of a quarterly report that almost nobody reads. And that number has just done something it has not done in over half a century. Central banks around the world, not hedge funds, not retail traders, not the loudest voices on financial television, but the institutions that print and manage the world's currencies have been buying gold at a pace that would have seemed almost irrational a decade ago. And two of the largest, most consequential economies on earth, Russia and China, sit at the very center of that shift. If you understand why they are doing this, you will understand something most investors never bother to ask about their own portfolios. What actually gives money its value? And what happens when the people who run the system start quietly preparing for that value to change? Stay with me for the next few minutes, because by the end of this, you will see the current moment in a very different light than you did when you clicked on this video. Before we go further, I want to know something. In the comment section below, tell me where you're watching this from, and tell me honestly, are you holding gold, silver, or cash right now? I ask because the answer tends to reveal a lot about how people are feeling about the world, and I'd like to see in real numbers what this audience is actually doing rather than just what they say they believe. Let's start with the basics, because everything that follows depends on understanding them clearly, not as jargon but as ideas. Money at its core is a claim on future goods and services. When you hold a dollar, a euro, a ruble, or a yuan, you are holding a promise that someone somewhere will accept that piece of paper or that digital entry in exchange for something real. That promise has always rested on trust. Trust that the issuing government will not print so much of the currency that it becomes worthless. Trust that the country's institutions are stable enough to honor contracts. Trust that if you need to convert that currency into something else, another currency, a bond, a physical asset, you will be able to do so freely without political interference. For most of the post-war era, the United States dollar has been the ultimate expression of that trust. It became the reserve currency of the world, not by decree, but because after the devastation of the Second World War, the American economy was the largest, the most productive, and the most stable, and the rest of the world needed somewhere safe to park its wealth. That arrangement built the modern financial system. Oil is priced in dollars. Global trade is settled in dollars. Central banks around the world hold dollars and dollar-denominated bonds as their primary reserve asset. It has worked more or less for 80 years, but trust is not a permanent condition. It is a relationship, and like any relationship, it can erode when one party behaves in ways that make the other party nervous. And here is where we need to talk about what actually happened in February of 2022, because it is the single most important turning point in understanding why central bank behavior has changed so dramatically since then. When Russia invaded Ukraine, the United States and its allies responded with a financial weapon that had rarely, if ever, been used at that scale. They froze roughly $300 billion of Russian central bank reserves. Let that sink in for a moment. Money that Russia's central bank believed it owned, money held in Western institutions, denominated in Western currencies, meant to be a safe store of national wealth, was simply made inaccessible by political decision. It wasn't stolen in the traditional sense. It was frozen, locked away, rendered unusable because of a geopolitical conflict. Now, whatever your view on the war itself, and this video is not here to render a judgment on that, the financial implication was seismic and it rippled far beyond Moscow. Every finance minister, every central bank governor in every country that is not a close, unconditional ally of the United States watched that moment and absorbed the lesson that no economics textbook had fully prepared them for. Your reserves are only as safe as your relationship with the country whose currency you're holding them in. If that relationship sours, your savings can be frozen overnight, no matter how large your economy is, no matter how legitimate your claim to that money. This is the moment that historians will likely point to years from now as the beginning of a structural shift in how the world's central banks think about reserves. And China, which has watched the Russia sanctions unfold with obvious and understandable attention, given its own tensions with Washington over trade in Taiwan, drew the same conclusion. If it can happen to Russia, it can happen to us. This is why the phrase de-dollarization has moved from the fringes of financial commentary into mainstream central banking conversation. It doesn't mean the dollar is about to collapse tomorrow. I want to be very clear about that, because sensational claims of imminent dollar collapse have been made for decades and have consistently proven wrong. What it means is something quieter, slower, and in some ways more significant, a gradual diversification away from dollar-denominated reserves and toward assets that cannot be frozen, sanctioned, or devalued by a foreign government's political decision. And there is exactly one asset that fits that description perfectly. Gold sits in a vault. It has no counterparty. Nobody can freeze it with a keystroke because unlike a dollar reserve held at a foreign central bank, physical gold held domestically is not a claim on someone else's promise. It is the thing itself. This is precisely why since 2022, central bank gold buying has surged to levels not seen since data collection began in the 1950s. The World Gold Council has documented central banks purchasing over 1,000 tons of gold annually in multiple recent years, roughly double the average pace of the decade before the Russia sanctions. China's central bank has been a consistent publicly disclosed buyer, adding to its reserves for over a year straight in recent reporting periods, and many analysts believe China's actual holdings, including gold held outside the official People's Bank of China figures, are considerably larger than what is disclosed. Russia, for its part, had already been building its gold reserves for years before 2022, partly in anticipation of exactly this kind of confrontation, and has continued to treat gold as a strategic pillar of its reserve policy since. I want to pause here and explain why this matters so much more than it might first appear. Because understanding the mechanics of gold as a monetary asset requires us to step back and look at the entire architecture of the modern financial system, including the part that affects you directly regardless of what country you live in. The behavior of the Federal Reserve. The Federal Reserve's core job in theory is simple: keep prices stable, keep employment high, and manage the money supply in a way that supports sustainable growth. In practice, this means the Fed is constantly making a trade-off between two competing forces. Raise interest rates too aggressively and you risk choking off economic growth, causing unemployment and recession. Keep interest rates too low for too long and you risk inflation, too much money chasing too few goods, eroding the purchasing power of every dollar in existence. Since 2020, the world has lived through an extraordinary experiment in monetary policy. Trillions of dollars were created and injected into the economy to cushion the shock of the pandemic. That was followed starting in 2022 by the fastest series of interest rate hikes in 4 decades as the Fed tried to wrestle inflation back under control. Both of these actions, expansion and contraction, leave scars. The expansion phase devalues existing currency because more units are chasing the same amount of real goods. The contraction phase, meanwhile, makes government debt more expensive to service because higher interest rates mean higher interest payments on the trillions of dollars the government has borrowed, and this is where the debt cycle becomes impossible to ignore. The United States, like most developed economies, has been running persistent budget deficits for years, financed by issuing government bonds. As long as interest rates stay low, that debt is manageable. The interest payments remain a small percentage of the overall budget. But when rates rise, as they did dramatically in 2022 and 2023, the cost of servicing that debt rises with it. The U.S. government now spends more on interest payments on its debt than it does on national defense, a milestone that would have seemed almost unthinkable a generation ago. This creates a difficult, self-reinforcing dynamic. The government needs to keep borrowing to fund its operations. That borrowing requires issuing more bonds on the market, all else equal, push interest rates higher, or require the Fed to step in and buy bonds itself, effectively creating more money to absorb the new debt. Either path, higher rates or more money creation, has consequences. Higher rates slow the economy and increase the interest burden further. More money creation risks reigniting inflation. This is often referred to as a debt cycle, a concept that economists like Ray Dalio have written about extensively, drawing on patterns that have repeated across nations and centuries. Periods of expanding credit and debt, followed eventually by a reckoning where the debt burden becomes unsustainable relative to the size of the economy, and painful adjustments follow, whether through default, inflation, currency devaluation, or some combination of all three. This is not a uniquely American story, and it's not a doom prophecy. It is simply how large indebted economies have historically resolved unsustainable debt loads, and it is the backdrop against which central banks around the world are making decisions today. When you understand this backdrop, the gold buying by Russia and China stops looking like some kind of aggressive economic maneuver and starts looking like something much more rational: insurance. If you were the central bank governor of a major economy and you watched the world's reserve currency issuer running deficits that require ever-increasing debt, watched interest payments consume a growing share of the federal budget, and watched that same country demonstrate a willingness to freeze the reserves of nations it disagrees with politically. Wouldn't you want at least part of your national savings in an asset that doesn't depend on anyone else's promise? This brings us to silver, which deserves its own moment of attention because it behaves differently from gold in ways that matter enormously for how you think about it. Gold is almost purely a monetary and store value asset at this point. A small fraction of annual gold demand goes toward industrial use. Silver is different. A significant portion of silver demand comes from industrial applications, electronics, solar panel production, medical equipment. This means silver's price is influenced by two forces simultaneously, the same monetary and safe haven dynamics that drive gold, plus genuine industrial demand tied to global manufacturing and the energy transition. Historically, this has made silver more volatile than gold, prone to sharper rallies and sharper corrections. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has swung dramatically over the decades and is closely watched by investors trying to gauge whether silver is historically cheap or expensive relative to gold. When that ratio sits at historically elevated levels, meaning silver is unusually cheap relative to gold, some investors interpret it as a signal of a potential opportunity. Though I want to be careful here because historical ratios are observations, not guarantees of future performance. Let me tell you about someone I'll call Daniel, 34 years old, working in logistics management in Ohio. Daniel is not a fictional stand-in for anyone real. His story is a composite I'm sharing to illustrate a pattern I want you to recognize in yourself. In early 2020, Daniel watched the initial wave of pandemic panic and, gripped by fear, sold nearly his entire retirement portfolio and moved it into cash. Convinced the stock market was about to enter a prolonged collapse, the market, of course, recovered sharply within months, and Daniel spent the next 2 years watching from the sidelines as the value of his cash holdings was eroded by both missed market gains and rising inflation. What Daniel experienced is a textbook illustration of a very real biological process that plays out brain during moments of financial fear. When we perceive a threat, and a collapsing portfolio absolutely registers as a threat to the brain's threat detection system, the amygdala activates a fight or flight response, flooding the body with cortisol and adrenaline. This response evolved over millions of years to help our ancestors survive physical dangers, a predator in the grass, a cliff edge in the dark. It is remarkably effective for those situations. It is remarkably poor for financial decision-making because it pushes us toward immediate drastic action precisely when patience and reasoned analysis would serve us better. The prefrontal cortex, the part of the brain responsible for long-term planning and rational weighing of evidence, essentially gets overridden during acute stress. This is why so many investors sell at the bottom and buy at the top. They are quite literally making decisions with the part of the brain built for escaping lions, not the part built for evaluating a 40-year retirement plan. Contrast Daniel's story with someone I'll call Priya, 51 years old, a small business owner in Toronto. Priya began allocating a modest fixed percentage of her savings, around 5%, into physical gold back in 2018, not because she was predicting any specific crisis, but because she had read enough economic history to understand that currencies go through cycles, and she wanted a portion of her wealth that didn't depend entirely on any single government's fiscal discipline. She didn't try to time the market. She didn't chase headlines. She simply treated gold the way an insurance policy is meant to be treated, a small, steady allocation that she rarely thought about, that sat quietly in the background of her broader portfolio of stocks, bonds, and her business equity. By the time gold prices moved meaningfully higher in recent years, Priya's allocation hadn't made her wealthy on its own, and that was never the point. What it done was reduce the overall volatility of her net worth during periods when other assets were falling, giving her the psychological steadiness to avoid panic, selling her stock holdings during downturns, because she knew a portion of her wealth was insulated from those same pressures. Her outcome illustrates something important. The value of gold in a portfolio is often less about spectacular returns and more about the emotional stability it provides, which in turn allows an investor to stay disciplined with the rest of their holdings. Now, I want you to think for a second about why this matters to you specifically, regardless of whether you live in North America, Europe, Asia, Africa, or anywhere else. Because currency dynamics are not confined to any one country. When central banks diversify away from dollar reserves and into gold, it has ripple effects on currency strength across the board. A currency strength is, at its core, a reflection of confidence. Confidence in the issuing country's economic management, its political stability, its trade balance, and its debt trajectory. When a major reserve currency faces even modest erosion of confidence at the central bank level, It can contribute to weaker demand for that currency in global markets over time, which in turn can contribute to a weaker exchange rate and potentially higher imported inflation for that country's citizens. This is not something that happens overnight, and I want to resist any temptation to make this sound more dramatic than the evidence supports. Currency snort shifts of this nature typically unfold over years, even decades, not days or weeks. But the direction of travel, based on the data we have from central bank purchasing patterns, does suggest a gradual structural shift in how the world's reserve managers are thinking about risk. If this kind of analysis is useful to you, this is a good moment to hit like on this video and subscribe to the channel, because I want you to stay with me through the rest of this. And I promise the final section is going to connect every piece we've discussed so far. The debt cycle, the Fed, the central bank gold buying, the psychology of fear and greed into a single coherent picture that I think will genuinely change how you look at your own long-term financial planning. Before we turn to history, it's worth spending a moment on liquidity, because it's a word thrown around constantly in financial media without much explanation, and understanding it will make everything else in this video click into place even more firmly. Liquidity, in the simplest terms, refers to how easily an asset can be bought or sold without significantly affecting its price, and more broadly, it refers to how much money is actually flowing through the financial system at any given time. When the Federal Reserve lowers interest rates or engages in quantitative easing, buying large quantities of government bonds, it is effectively increasing liquidity, making it cheaper and easier for money to move through banks, into businesses, into consumer spending, and into asset markets like stocks and real estate. This is why stock markets often rally when the Fed signals it will cut rates or ease policy, and why they often struggle when the Fed signals continued tightening. But liquidity also plays a crucial, often underappreciated role in the bond market, which is genuinely the largest and in many ways the most important market in the world, larger than the stock market, because it represents the borrowing costs for governments, corporations, and ultimately, indirectly, for every mortgage and business loan issued. When government debt grows to the point where investors begin demanding higher yields to compensate for the perceived risk of holding that debt, either due to inflation concerns or concerns about the government's long-term fiscal trajectory, borrowing costs rise across the entire economy. We saw a version of this play out in the United Kingdom in 2022, when a mini-budget proposing large unfunded tax cuts triggered a sharp, rapid sell-off in UK government bonds, forcing the Bank of England to intervene directly in the bond market to restore stability, and ultimately contributing to a change in the country's leadership within weeks. That episode is a vivid real-world illustration of how quickly bond market confidence can shift when investors begin to doubt a government's fiscal discipline, and it is precisely the kind of scenario that keeps central bank reserve managers awake at night, reinforcing their interest in assets that don't carry that same kind of confidence-dependent risk. This is also where geopolitical risk becomes inseparable from monetary analysis, rather than a separate category we can set aside. The relationship between the United States and China remains defined by genuine economic interdependence, alongside genuine strategic competition, spanning trade policy, technology restrictions, and tensions over Taiwan. Russia remains subject to extensive Western sanctions following the invasion of Ukraine, sanctions that have reshaped its trade relationships, pushing it toward deeper economic ties with China and other non-Western economies. The Middle East continues to experience periodic instability that affects global energy markets, and energy prices in turn feed directly into inflation figures worldwide. None of these tensions exist in isolation from monetary policy. A prolonged conflict or trade disruption can spike energy and commodity prices, forcing central banks to choose between tolerating higher inflation or raising interest rates further and risking economic slowdown, the same difficult trade-off we discussed earlier. Gold has historically served as one of the few assets that tends to hold or increase its value precisely during these periods of geopolitical stress. Not because of any mystical property, but because in moments of uncertainty, investors and institutions alike gravitate toward the one major asset class that isn't a promise from any single government, a pattern that is repeated across numerous conflicts and crises throughout modern financial history, from the oil shocks of the 1970s to the Gulf War to the 2008 financial crisis and beyond. Let's talk about historical parallels, because nothing in economics happens in a vacuum. And the patterns we're discussing today rhyme with periods from the past in instructive ways. In the 1970s, the United States faced a combination of high inflation, slow economic growth, and a series of geopolitical shocks, including the oil embargo that shattered confidence in the dollar following the collapse of the Bretton Woods system, which had tied the dollar to gold at a fixed rate. When President Nixon ended dollar convertibility to gold in 1971, it marked the beginning of the modern era of fiat currency, where money is backed not by a physical commodity, but purely by government decree and public trust. In the years that followed, as inflation soared into double digits, gold prices rose dramatically, moving from around $35 an ounce to over $800 an ounce by 1980. An extraordinary move driven by exactly the dynamic we're discussing today, a crisis of confidence in fiat currency during a period of high inflation and geopolitical. It took Federal Reserve Chairman Paul Volcker's aggressive, painful interest rate hikes, pushing rates above 20%, to finally break the back of that inflation and restore confidence in the dollar at the cost of a severe recession. That episode remains the clearest historical example of what happens when the market's trust in a currency stewardship is seriously tested, and it offers a useful, if imperfect, lens for understanding today's environment, even though the specific circumstances are quite different. We can also look at the 2008 global financial crisis, when the collapse of the housing market and the banking system triggered a massive wave of central bank intervention, including near zero interest rates and large-scale bond buying programs known as quantitative easing. Gold prices rose substantially in the years following 2008 as investors sought protection from what many feared would be runaway inflation resulting from all that newly created money. Interestingly, the inflation many feared in 2009 and 2010 didn't fully materialize until over a decade later, following the even larger monetary expansion during the pandemic, which is a useful reminder that the relationship between money supply growth and consumer price inflation, while real, doesn't always play out on the timeline people expect and can be delayed by other factors, such as where that new money actually flows in the economy. I want to introduce one more investor story here because I think it illustrates the flip side of Daniel's panic-driven mistake. I'll call him Marcus, 62 years old, a retired school teacher in the United Kingdom, approaching the final years before fully drawing down his pension. In late 2021, swept up by enthusiastic online commentary and a genuine fear of missing out, Marcus moved a substantial portion of his retirement savings into a concentrated set of speculative growth stocks and cryptocurrency positions, convinced by persuasive online voices that traditional diversified investing was outdated. When markets turned sharply in 2022 amid the Fed's rapid rate hikes, Marcus's concentrated positions fell by more than half, a loss that, given his age and proximity to retirement, he had very little time to recover from through continued employment income. Marcus's story illustrates greed's role in the same neurological system we discussed earlier with Daniel's fear-driven panic, just as fear triggers the amygdala and floods the body with cortisol. Anticipated financial reward triggers the release of dopamine, the brain's chemical signal for pleasure and motivation. When markets are rising rapidly and stories of overnight gains circulate widely, the brain's dopamine-driven reward system can create a powerful pull toward chasing those gains, often overriding rational risk assessment in much the same way fear overrides it during a crash. This is why market cycles so often produce the same painful pattern. Euphoric buying near the top, driven by dopamine and social proof, followed by panic selling near the bottom, driven by cortisol and fear, when a more measured, historically informed approach would have avoided both extremes entirely. This brings us finally to the insight I promised you at the beginning, the one that ties every thread of this discussion together. It is not a secret. It is not a conspiracy. It is simply the conclusion that emerges when you look honestly at the evidence we've walked through today. Central banks, particularly in Russia and China, but increasingly in other nations as well, including India, Turkey, and several Gulf states, are not buying gold because they expect the dollar to collapse next month or because of some coordinated plot to undermine the United States. They are buying gold because they are rational actors responding rationally to a changed world, a world where reserve assets denominated in a foreign currency carry a political risk that didn't exist, at least not to the same degree, a decade ago, and a world where persistent government deficits and debt loads raise legitimate long-term questions about currency purchasing power. This behavior represents a genuine data-supported shift in how the institutions that manage the largest pools of capital on earth think about risk. And here's the insight for you, the individual investor, sitting at home, trying to plan for your own family's future, decades removed from the meeting rooms where these central bank decisions are made. What the largest, most sophisticated financial institutions in the world are doing with a portion of their reserves is not a bad framework for thinking about your own portfolio, scaled appropriately to your own circumstances. Not because you need to predict a crisis, not because gold is going to make anyone rich overnight, because historically it hasn't. And I would be doing you a disservice if I implied otherwise. But because diversification across different types of assets, including a modest allocation to an asset with no counterparty risk, has historically provided a form of stability that pure currency or pure equity exposure cannot offer on its own. This is not a prediction about where gold or silver prices will be next year. Nobody can honestly make that claim with certainty. And you should be deeply skeptical of anyone who tells you they can. It is instead an observation about how the world's most careful reserve managers are behaving, and an invitation for you to think about what that behavior might reasonably suggest for your own long-term planning. As we bring this to a close, I want to leave you with something more valuable than any single prediction about prices. The investors who build lasting wealth across a lifetime are very rarely the ones who make the boldest, most dramatic bets. They are almost without exception the ones who understand the difference between their amygdala talking and their prefrontal cortex talking, who build diversified portfolios based on sound historical principles rather than headlines, who treat assets like gold and silver as one sensible piece of a broader strategy rather than a magic solution or a doomsday bet, and who resist both the fear that drove Daniel to sell at the bottom and the greed that drove Marcus to concentrate everything at the top. The world is genuinely changing in the ways we've discussed today. The erosion of unconditional trust in any single reserve currency, the behavior of central banks quietly repositioning their reserves, the long arc of debt cycles that have played out across history and will likely continue to play out in the future. But change, even significant structural change, unfolds over years and decades, not headlines and days. And the investors who thrive through it are the ones who stay informed without becoming anxious, who diversify without becoming paranoid, and who think independently rather than simply following whatever narrative is loudest in any given month. Stay curious, stay patient, read history because it doesn't repeat exactly, but it teaches. And whatever you decide to do with your own savings, do it because you understand the reasoning behind it, not because fear or excitement pushed you into it. That, more than any single asset, is what actually preserves wealth across a lifetime. Thank you for watching, and I'll see you in the next one.